So the idea that gold is overbought, oversold is rubbish. It's got nothing to do with it. Really, what we're looking at is the relationship between gold and fiat currencies, which depend entirely on faith.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money. Now, this is the show that goes beyond the headlines to uncover the truth about the gold and silver markets with world-renowned whistleblower and industry expert, Mr. Andrew Maguire. And this week, he's joined by a very special guest. You know him well, Mr. Alasdair Macleod. And look, if you haven't checked out his Substack newsletter on gold and sound money, check it out. We'll just leave a link down there below. And, we're talking gold and silver, so you're not going to want to miss a minute of this conversation. So let's head over to the UK and join Andrew Maguire and our featured guest, Mr. Alasdair Macleod. Over to you, Andrew.
Well, Alasdair, this is manna from heaven. Thank you very much. What a timely visit. And I think, I know that you've got a hard close today. And so let's, and I know you're not 100% well. We don't want your throat to wear out with your cold here. So we'll get straight to it. But thank you for joining us. And perhaps we could just start with probably the elephant in the room and what has amazed me, and we've just done an episode that incorporated that, is this so-called overbought condition in the futures market, which has wrong-footed quite a few people. In fact, it's wrong-footed one or two people, which I'm really surprised at, who have been busy exchanging their fiat, busy exchanging their gold, their money, the real gold for money for guess what? Dirty fiat exchanges, and have missed, in one instance that I know of for sure, has missed the last $1,000 rally, waiting for this oversold condition to revert. Alasdair, I know you've got a lot of hard data here that is probably going to surprise a lot of people.
Yeah, well, I think your friend who took his profits $1,000 below this, you'll probably power back in over 20,000 sometime. I don't know. That's what tends to happen. I mean, I speak as as a stockbroker of some decades, knowing the human behavior, if you like, of investors and speculators and so on and so forth. And there is absolutely no doubt. I mean, the sensible advice to an investor is, when you've got a nice profit like that, book some of it and just run the rest for free. As for overbought, no, it's not. If you just look at the open interest on COMEX, there's no way it's overbought. I mean, the amazing thing is that most of this rise, both in gold and silver, has been on the back of a bear squeeze, not, enthusiastic buyers rushing in and buying it. And there's a complete misunderstanding, actually, about what gold is about. I mean, there are enough gold bugs running around saying, oh, it's going to the moon, or it's going to do this, going to do that. But actually, do they really know what they're talking about? I mean, they tend to look at charts, let's face it. And they've also got this thing in their brains about, government is wicked and therefore gold is good. It's not good enough, actually. You've got to really understand what the game is about. The point is that, it goes back all the way to Roman times. They decided the difference between final settlement and deferred settlement was settlement in something without counterparty risk, and that was metallic. And, when they produced the first Roman laws were dated in 448 BC, they said, settlement is metallic. In those days, it was a pound of bronze, basically. That was the unit, called the ice. And gold came later, of course, because it's a lot more convenient and so on. And it was also being discovered a bit more. So, there was a little bit of quantity there. So it could be used for the temporary storage of one's labor, if you want to really sort of go back to classical economics. But otherwise, everything else is deferred settlement. It's a promise. It's a promise to pay. You might think that you're paying a workman for painting the outside of your house, and okay, fine, you paid him, but there's no final settlement, because what you've done is you've done a probably cash, in which case it's the counterparty risk is actually with the central bank, or alternatively by bank transfer. In other words, you've just transferred one form of deferred settlement for another. Nobody does final settlement nowadays. But when you get a loss of confidence in the value of the currency, which is the top level of credit, if you like, in any economy, then that loss of confidence is reflected in a falling value for the currency. And that is exactly what's going on. So the idea that gold is overbought, oversold is rubbish. It's got nothing to do with it. Really, what we're looking at is the relationship between gold and fiat currencies, which depend entirely on faith. And it's as simple as that. So, where are we? I mean, I think we can really say that gold over millennia, basically, its purchasing power varies very, very little. And there's ample evidence of that. But when it comes to fiat currencies, they come and go. They don't last terribly long, is a short answer. I mean, the dollar has really been a fiat currency for some considerable time. I would say since 1933, if you like, just before, they devalued it from 20.67 to $35 an ounce. But more specifically and more obviously, since the Bretton Woods Agreement ceased, was suspended actually, in 1971. So we've had 54 years of pure fiat currency. But the destruction process actually started earlier than that. So we just bear that in mind. I think really what gold is telling us is that we're coming to the end of that era. And, anyone who's left holding the fiat baby is, basically has had it. That's what's going to happen. So that, I think, is the background. But the interesting thing is that the Chinese, who are a bit old-fashioned over these things, they didn't have the benefit of John Maynard Keynes teaching them economics, etc. They came out of communism, if you like, with the belief that the capitalist system would fail. And of course, the failure of the capitalist system, would be through its currency. And so they started accumulating gold, really, shortly after Mao Zedong passed away. And I've got an English copy of the regulations dated 1983, appointing the People's Bank of China with the sole responsibility for managing and acquiring the nation's gold and silver reserves. And this is terribly important. It's important to know this. The second thing to know is that no one in China was allowed to own gold until it was legalized in 2002. And that was the point where the Shanghai Gold Exchange opened, which facilitated the delivery of gold to the public. So we had this period between 1983 and 2000 when China state acquired gold. And so where did it come from? Well, we had a massive bear market between those dates. And not only that, but, it was quite clear that quite a lot of central bank gold held in the West had actually gone out on lease, never to be returned. This was estimated by Frank Venerosa to be somewhere between 10 and 14,000 tons. In other words, between a third and a half of all central bank gold was out on lease, sold into the market, and not coming back. Now, Venerosa reckoned that it was probably adorning the necks of Asian women. I think it's another story. I think the People's Bank of China was in there quietly picking it up. I estimate, now I have no firm figures on this at all, and I have to say that the thing about the gold market, as we all should know, is that nobody wants to say that they actually own any gold. They want to keep it secret. And I'm not talking about individuals, I'm also talking about governments. And this is the whole thing. The US government is a prime example. I mean, we keep on wondering how much gold they've actually got. And what do they say? Nothing. So when it comes to China, I reckon that they'd accumulated roughly 20,000 tons between 1983 and that year, 2002. Now, since then, of course, the Chinese government has continued to accumulate gold. Not only that, but mine output is the thick end of 10,000 tons. I mean, China invested hugely in its own gold mine production and rapidly became the largest producer nation by far, eclipsing South Africa, which was declining quite rapidly as it happened back in the, I suppose, sort of 1990s and into the early noughties. And the other thing, of course, is that state-owned refiners were bringing in doré from abroad. I mean, particularly, obviously, Mongolia, and paying them for the doré. And where did the gold go? Didn't leave China. I mean, as far as the relationship between gold and China is that China is Hotel California. It comes in, that's no problem at all, but it can't get out. So that has been the policy. Why is it this policy? It's this policy because the Chinese understand the importance of gold. Now, since ESGE opened, over 27,000 tons of gold has been delivered into private hands. Now, some of that would have returned into the Baltic system as scrap. But I don't care, because that just gets redistributed elsewhere. It's not going out of China. Never has done.
No.
And on top of that, of course, you've got the banks. The banks run gold accumulation plans for their depositors. And this gold is not delivered out of the Shanghai Gold Exchange. It is stored within the Shanghai Gold Exchange. So we don't know how much gold there is there. But I should think it's quite a lot. I pencil in a figure about 10,000 tons. Now, I think that might underestimate the situation for the very simple reason that household savings rate is in the order of, it's over 30%. And that's the equivalent of $5 trillion a year. Now, it used to go into off-plan apartment buildings and stuff. That's gone. Let's forget that. Stock market, maybe a little bit, but I think that's got very, very limited appeal. I mean, really, and then the other thing you've seen, I mean, mostly it's been accumulating as as deposits on the bank's bank accounts, deposit accounts. But for the last year or two, the People's Bank has been reducing its sort of main interest rates, and the banks with it. And so, what does the housewife do? Well, the answer is that she opens a gold accumulation plan, which she can do for as little as 500 yuan. So that's, which is less than $100. So, this is actually very important. If you take this all together, we are, in my estimation, looking at a figure like 75,000 tons out of a total of a bit less than 200,000 tons of above ground gold stocks.
Yeah.
China's cornered the gold market. That's what it boils down to. Because it's not just China. You've got India, which has got massive amounts of bullion held in the form of jewelry. I mean, most of the Chinese public gold is actually jewelry as well. And you've also got Russia. Now, I understand on pretty good authority that Russia's got two sovereign wealth funds, which have a total of about 10,000 tons of gold between them. And then you've got the Russian Central Bank, which has got a further, 2.3 thousand tons, whatever. You've also got the whole of the Shanghai Cooperation Organization and BRICS, all their central banks. Presumably they've got sovereign wealth funds as well. Now, all this is meaning that the liquidity we have here is minimal. Now, let's look at the demand side. So far, this hasn't mattered because nobody wants to buy gold. I mean, any investment manager isn't going to earn fees by putting his punters into gold. He would rather put them into something which is going to pay him a bit more. And not only that, but the regulators are on his side. The regulators turn around and say that physical metals are not regulated investments. But of course, this was why they said they set up ETFs, to get around this regulatory hurdle. But the ETFs are beginning to grow. People are beginning to buy into them slowly. But the other thing, which I think is very important on the demand side, is that we now see analysts at the major US banks turning around and saying, we believe gold's going at 4,000, whatever their reasons. I don't care. I mean, they don't know what they're talking about. I reckon that's my default assumption anyway. But, the fact that they are saying it, and the fact that the investment managers within those banks, who are typically managing or responsible for over $1 trillion, we're looking at banks like Goldman Sachs, Bank of America, Citibank, Citicorp, whatever they call themselves now, etc. We're talking about huge numbers. They haven't got any. I don't think they necessarily know how to get it, actually. I mean, so that, this is interesting. When you look at the complete investment management universe around the world, it is estimated that portfolios are worth some $300 trillion. $300 trillion. Now, gold ownership of that, you just look at ETFs and maybe sort of make a few assumptions about, bullion being stored and so on. But, basically it's ETFs and nothing else. It's less than 0.5% of that. I mean, it really is. Less than 0.5% is in gold. And yet you've got these behemoths in America now thinking, oh, we better buy some of this. Now, to put it into context, my China story suggests that the amount of liquidity, which is unspoken for, including jewelry in the West, is probably in the region of about 40 to 45,000 tons. That's all. That's it. We can see what's in the vaults. We can't see what's in the Swiss vaults. That's something I don't know. I would, someone gives me a number, it'd be super. But I think quite sensibly, the Swiss don't produce these numbers. That's what I would assume anyway. But it does mean that if a 1% increase in allocation, portfolio allocation of that 300 trillion was to take place at current prices, you're looking at 25,000 tons. Where's it going to come from? I mean, the answer basically is that we're heading for the most enormous crisis in the gold market. And the figures are very different for silver because being an industrial metal, etc., but the same principle applies. The liquidity is just simply not there, which is why it's sort of hurdling up $1 at a time at the moment. This is a squeeze on the system. And, this is very serious. And I think so, I can understand your punter selling off, $1,000 below the current level and maybe living to regret it. But, I can understand that. But the bit he's missing basically is he's going to be out of the market on the biggest, sharpest squeeze probably seen in history. I think that's where we're heading.
Yeah, and as you rightly say, Alasdair, where is the gold going to come from to meet this sudden demand? And you're talking about institutional money here looking to get involved in gold. And I mean, as you say, so 0.5% is how do you even move up from that point? How do you even look to buy 25, 30, 40,000 tons of gold? I mean, it is going to require at least that amount of gold. So it's not coming out of China. It's moving into China. And one of the interesting things that I've noticed is I know of two institutionals who won't deal in London or won't deal with any LBMA CME product. ETFs, they're buying ETFs in Western-facing SGEI vaults where they can trade it. You talked about liquidity. You nailed it. It's all about liquidity. That's where you're going to find your liquidity. Not here, but there. And you've kind of put some numbers around that, which all makes sense.
Well, I'd question whether you're even going to get the liquidity over there. I mean, basically, the history, if you like, I mean, the more recent history, following our very successful gold standard, back in the 19th century, the history of the 20th century is that central banks grab the gold and they won't part with it at all. The idea that they're actually going to go on a gold standard and, say to all comers, we'll exchange our currency at a rate which is as follows. And, if you're not happy with our paper, then come and exchange it. I think we're an awful long way from returning to those days. You're not going to get liquidity being released from the market. I think that's the key thing. And the reason I mention household savings is that, these guys are just as human as you and me. They see something going up and they chase it. They're not going to say, "Oh, thank God, I could make a bit of a profit here." Unlike some of our Western investors,
Yeah.
take a rather different view. Just let the figures sink in for a moment. If you're talking about 30% household savings rate, you are talking about $5 trillion a year seeking an investment.
Mm-hmm.
How do you accommodate that? I mean, the Chinese economy has been growing pretty well. I don't buy into government analysis of these things and macroeconomics. It's a load of rubbish. It gives you no idea exactly how things are really performing in China. But I'm sure that some of that would be in capital investment is bound to be. I mean, because the economy works there, it works pretty well. I mean, much as our analysts, macroeconomic analysts in the West hate it, they hate this proof that they're wrong. But what the Chinese are now doing, and this is fascinating because having cornered the market, they're now saying to their friends, that's not us, by the way. I'm talking about the Shanghai Cooperation Organization and also BRICS.
Mm.
Saying to them, look, we're opening vaults, SGE vaults, Hong Kong, Saudi Arabia. I heard, I saw something yesterday, India. I can't substantiate that, but it wouldn't surprise me at all. And also throughout Southeast Asia, there will be exchange facilities whereby you can swap Chinese yuan for gold and vice versa. The only thing we don't have is the rate at which it might be fixed in the future. But you can see that they're setting up a network, if you like, for governmental settlements. This is not going to be available to citizens, I believe. I don't think so. I can't see it. But it will be available for governments settling their trade imbalances. And I think the point about it is that it will make the yuan attractive, if you like, as a foreign currency. The other thing is that they are setting up a process whereby if you're going to, let's say, sell South African rand to buy Indian rupees, at the moment you have to sell your rand to buy dollars, sell the dollars to buy rupees. They're cutting that out completely.
Mm-hmm.
This is going to release foreign exchange commitments, which, according to the Bank of International Settlements, they reckon is around about $80 trillion. We're talking about the dollar's usage declining quite rapidly on these developments. So where does that leave the dollar? Well, it's the end of the fiat currency system. I mean, that's what we're seeing. All we don't know is the precise timing. But everything we see rather suggests it's going to happen sooner rather than later. So where does that leave gold? Well, wake up, folks. This is beginning to happen now. And I really can't see how this one's going to be resolved without many, many eggs being broken. I really don't.
And I think what you're saying here is not that gold's going up. It's just requiring more of these debased fiat currencies to buy this same ounce. So if I'm a seller of gold, what is my offer price? My offer price is based on that equation. And also, if I see, if there's two fixes now, competing fixes in Shanghai. And it's the funny thing is, I don't know if you saw, you must have seen that Bloomberg article, I think last Tuesday, threw the cat amongst the pigeons, when they came out and stated that China aims to become the custodian of foreign sovereign gold reserves. And then they went through this article was excellent. And it's all the things you've been saying. I mean, a long time ago, it was all a conspiracy theory. Oh no, well, that couldn't possibly be happening. Of course it was. But the amusing part, what really amused me, was the World Gold Council followed that up with a link that showed that gold trading volumes in London still dwarf Shanghai. Give your head a shake. I mean, you're talking about the 600 tons of gold that shuffles around, unallocated gold that shuffles around the books of these banks, when you've only got 3 to 5 tons actually settling physically at the fixes. It's a farce and on the other side of the equation, you look at roughly 450 tons or whatever of Shanghai gold moving around, but it's physical. It's real physical. And I think on one day, we saw, and I don't know if you've seen other days like this, but one day we saw 53 tons entering the warehouse. Now, this is physical gold, as you say. So there's an offer that was hit to take that into the vault. And as you say, it's not coming out again. It is. So it made me laugh, and I think it's sort of amusing, almost a meme, that they put up this chart showing this tiny little line where Shanghai was. Well, I'm sure you saw it. You must have had a shot.
No, I didn't see it, but I'm perfectly aware of what you're talking about. I mean, because really what we're looking at is the demise of the paper system. Because people are beginning to understand why you should hold gold. And as I say, China has basically cornered the market. Call it the physical market. They've cornered that in effect. So where does that leave paper? Well, I mean, paper's just a bunch of promises with nothing to back it. It's not gold. It's credit. And, it's credit which, so long as the counterparties are solid, then you could say that the paper is a gold substitute. But when we see the fiat currency system coming under huge pressure and looking at the end of the whole fiat currency system, then all these paper promises are going to turn out to be worthless. And I was talking about the World Gold Council. I was slightly amused. I mean, I think they've rather lost the plot. Either that or I've lost the plot. It's quite possible. I think what basically, they've been working with the LBMA to get every bar registered, and this is just PC stuff. I mean, what's China going to say about this? I think there's an old-fashioned Churchillian expression, something like that, but the other way around. And where's all the gold? Well, it's flown. And then the latest thing was the World Gold Council saying, we're going to digitize it, which I think is a sort of buzzword, and I sort of think, they really haven't got the plot at all. The idea of digitizing it, I mean, but you see, to be fair to them, they're looking at a market which is exclusively the investment management industry. And so, they're trying to think like investment managers, which is the wrong way to think. I mean, they've missed that boat completely. So I think the whole thing is that it's a bit of a farce, really. I mean, don't get me wrong. I do like a lot of what the World Gold Council does. I mean, particularly its work on statistics and things like that, which we know are incomplete, but their statistical stuff can be extremely useful. For example, they collect very detailed statistics on ETFs, that sort of thing. They're also, now that you can't get daily fixes without having to pay some horrendous amount of money to someone or other, they've stopped even doing that. But you've still got prices going back to 1978. I actually managed to go back further than that, but That's because I'm a bit weird, I think. But it's our institutions. I mean, the broader point is that our institutions are no longer fit for purpose in this market. And anyone who's guided by them is making a horrid mistake. I really do think so.
Yeah, and I think there's so many clues that really this paper versus physical battle is now, as far as the West is concerned, in the rearview mirror. Because and what really struck me as amusing, Alasdair, the last time that we saw a margin increase in gold to 17,000 was in November 2024. And guess what had happened? The price had risen and risen and risen. And as was always the case, okay, let's put a margin increase in. And guess what? All these leveraged spec longs, out they go. And you got like I think $250 or $300 rinse out until they were all gone. And that was the game. What cracks me up though, here we are, and we're talking, $1,300, $1,400, $1,500 higher. No margin increase. And I believe the only reason there's been no margin increase is because the shorts are on the hook. And a margin increase would devastate the shorts because anyone with that much credit, it is credit essentially, that much credit in a price rise of close to $1,500 bucks, it can absorb the odd little margin call. So you put a margin call, it's not going to rinse many longs out, but it sure as hell will literally. And we do know, because we actually, if you think about it, you look at the charts and you see a series of higher and higher and higher stair steps. And we all know that it is the physical markets, which coming from China, etc., are being set in outside of the RBMA, that are actually underpinning those rally points. But it's so interesting because I think that's why every now and again, and we just had another Bank of International Settlements squaring. Now, at the end of each month, there's a squaring. It was actually exactly $409 an ounce higher than the last squaring. $409 an ounce. Now, holy smoke, someone's borrowed derivative gold and there's still 30 tons outstanding. We all believe, I mean, my assertion is there's only one short in the market, it's the Fed. Who else? There's no bullion bank we know of that is short gold for their own book. So $409 it's going to be like 4 billion or something in losses for the 30 tons still has to be repaid. And they only repaid 4 tons last month. It's still outstanding. So it's really interesting.
Well, that is interesting. The other thing that fascinates me is that the futures market is being used as a means of delivery. I mean, I don't know if you saw, but the stands for delivery yesterday were, I mean, in gold, it was something like 66 tons.
Yes, it was.
Just in one go? Silver was
still
huge.
24 tons to sell, to deliver.
Yeah. And silver was huge too. I mean, that was 1,500 tons or something. I did work it up. I can't remember what it was. But this is enormous. I mean, what it means is that the gold that's been delivered this year, or stood for delivery, this year has totaled about $950. 950 tons this year alone. And if we're looking at silver, I think the figure is something like 12,000 tons. I mean, these are enormous numbers. They really are. And you're looking at, in the case of silver, you're looking at something like 58% of global mine production. Which is 800 million ounces. I mean, this is what is going on. I mean, you've got to go and buy a future in order to get your bullion. This quite clearly shows that there's nowhere else you can go and get it. Now, that having said, I do understand that the retail market is slightly different. And there are interesting cross currents there. I mean, I understand that, Krugerrands are readily available and in great big quantity. And when it comes to kilo bars, I mean, you can buy those quite easily, sort of 1, 2, 3, 10, whatever. That's absolutely no problem. But as soon as you go out and beyond that sort of the wealthy retail market, as it were, it then gets extremely difficult, as I understand it. Is that your experience as well?
100%. The larger the size, the more the premium.
So, I mean, this is the way it's going. And, going back to the 1% portfolios is 25,000 tons. Where the hell is it going to come from? I mean, the answer basically is that the gold price measured in fiat is going to spiral out of control. And then, of course, you've got the implication about what is the value of fiat. Now, we all turn around and say, well, is gold going up rather than fiat going down? Yeah, but, that's going to force the Chinese, I think, into a situation where they have got to start considering sooner rather than later a gold standard to protect their yuan, because their yuan will be going down along with it. I mean, unless they protect it. And the other thing, which so far nobody, I think, actually understands, is that when you get the end of the fiat currency system, essentially you're predicting the collapse of their purchasing power. Everybody in the investment management industry thinks that, okay, inflation's a bit sticky, but it'll probably come down next year. We're going to get cuts in interest rates. Wrong. Prices are going to rise hugely. But of course, the thing that nobody really appreciates is it's not prices rising, but it's the purchasing power of the currency collapsing. I really do think we're in for a period which looks like replicating what happened in Germany between 1922 and November 1923. We'd already had a post-war decline, a substantial decline in the purchasing power of the Reichsmark. It steadied between 1920 and late 21, when there was a stock market crash. We've got a credit bubble here. That's going to crash. So this is actually a replication, if you like, of end of World War I, end of COVID. Okay? Purchasing power of currencies goes down. In other words, we saw inflation rising, interest rates rose with it. Now it is stabilized. And we've got a lovely period of anybody who's got anything in the stock market is doing wonderfully, thank you very much indeed. Making lots and lots of money with his Nvidia and his Bitcoin and God knows what. That is just absolutely the same as 1920 to 1922, the end of 1921. And what follows, we're about to see. And this is similar. I mean, it was the end of the Reichsmark. And it's going to be the end of the dollar and all other fiat currencies that sail with it. And what that means is, if you look at what happened, all the stories about, wheelbarrows full of cash and all the rest of it, and the complete collapse of values, like property, people making money. One way in which you really will make money as a manufacturer is to manufacture to export to Russia. Because Russia will go on a gold standard the moment China does. And what you'll see is your manufacturing costs sinking along with the currency, but your margins protected when you get paid in rubles or yuan. That's what Hugo Stinnes did, the inflation king, back in 1922 to 1923. He became the wealthiest man in the world. His costs were in collapsing Reichsmarks, and his profits were in gold-backed dollars. And he owned something like a quarter of all German industry, when the thing ended. And Fritz Thyssen was another one. Now, Thyssen is a name we know from the steel industry, and that's still around. So this is damn serious. What does it mean, for the gold price? In a sense, it's irrelevant. What's really relevant is the moment people wake up and understand it's not prices going up, but their currency going down, then they will dump their dollar deposits, their credit, if they've got any, just to get the hell out of it, and buy food, I don't know, anything you can get your hands on, because you don't want the damn currency, because it's going to buy even less by the end of the day. That's what we're heading for. It's a horrifying thought.
It is.
But I think that this squeeze in the gold market, and also silver, and it won't be just confined to them, because if you look at the value of base metals, they've been left behind hugely in all this. I think that's going to be a big catch-up. The overall consequences of this, I think, are going to hit everybody very, very badly. But it does mean that you've got to hoard gold as much as you can. Silver as well. Of course, the other thing is that governments could be stupid, as they always are, and they decide, we're going to confiscate gold. So keep it away from the government, keep it away from the banks, because the banks will do what they're told by the government. Keep it out from the banks, and don't tell anyone you got it. Silver, I think it would be a lot harder for them to confiscate that. I really do. So that makes silver especially attractive in this collapse scenario. And also, it's probably, I don't see necessarily that we'll be going out and spending our gold or whatever, because that's not the role of gold, really. What we will do is we will find, our currency, we will liquidate whatever gold we need for currency, whatever its value, as it's needed. And you'll be able to buy a nice big mansion and country estate and all the rest of it for, sort of 10 ounces of gold. That's what happens. But you need to get your Britannias, maybe. If you can get someone to accept your Britannias, they'll probably bite your hand off, but then you can buy all
There's no capital gains tax either. So
not on that, no, or on sovereigns.
Yeah, which is again an amazing, because I sometimes say to people, look,
don't tell Rachel. Don't tell Rachel.
Yeah, exactly. But I think, maybe if you're going to buy a single kilo of gold, why not buy the equivalent in Britannias or in
exactly.
sovereign?
The premium's only 2 or 3%. It's
I know. It's nothing, absolutely nothing. And then you've not only that, we're living in a communist regime here, and they're coming after anyone that's got any wealth. And we don't even know how that's going to roll out, shortly. But this is really timely, because I think what you're saying here, look, wake up, because this is real. It is a problem. It's going to happen, and obviously there is an opportunity, and especially you talk about gold and silver. Look at every other currency, every other fiat currency that prices gold and prices silver has been through the roof a lot, led the way higher. And I look at CNY silver, Euro silver. Forget 2011 highs in dollar silver. It's through the roof. It's just every day. It's higher and higher and higher. If anyone wants, to me, I'm saying to everyone right now, why would you not go after, swap some dollars for silver now? Because it's so clearly, it's your arbitrage. It's quite clearly undervalued. They've been sitting on it a long time. There's obviously a lot of short stops above the market. Otherwise, they'd have raised the margins on it by now. And it's a panic. So to me, that's what I'm saying to people right now. What should I do right now? And I'm agreeing with you. Silver has to be a bargain.
Yeah, absolutely. And there's absolutely no monetary use priced in it. You've got a gold silver ratio of 80 odd. If it was going to be priced properly as money, you'd be looking way below that. I don't think we get back to the sort of Sir Isaac Newton, 14.5 ounces of silver to 1 of gold type thing. But I can easily see this below 30. In this sort of panic. And that does give you, sort of huge outperformance. And of course, the other thing is that while the institutions might be fretting about where the hell we're going to get all this gold, the average investor, the man who feels that he's missed out on the gold run is going to go for silver. He's bound to, because apart from anything else, he doesn't have to fork out the thick end of $4,000 for an ounce. He can he can buy an ounce for around about 47, 48. So that is extremely attractive, I think, to most people. So I do see a bit of leverage there. The other thing possibly is, I think that institutions will go for gold mines and silver mines and so on. And I think the overall mining industry, I think, has been very, very suppressed in terms of its value. If you look at the main indices, they're more or less, talk about mining's, gold mine index or whatever. They're more or less doubled from the bottom, but this is from very, very depressed levels. But it does mean that you've got to have the ability to analyze mines, or at least know who to follow, which is probably, what most people will do. That introduces a degree of complexity, as well as that. If you buy into stock shares, whatever, basically you're buying credit again. And now I know people think that, a company isn't inflation proof, or, it gives you some protection from inflation. But the problem there is that it is still credit, because what you're doing is you're buying into a management promise to give you a stream of dividends. Well, they don't even pay that nowadays. So
you're just treading water then. You're just treading water. You're not doing anything.
Yeah. I think the key to it, Andy, the key to the acceleration in the market is going to be when this credit bubble pops. I think we're within months of it. In fact, I think it probably happened by the year end. October seems to be, and here we are on the 1st of October, it seems to be a pretty good month for an autumn crisis. So anyway.
Well, Alasdair, we should. I'm cognizant of your terrible cold and sore throat, so I think we've been blessed to have you here today. I think people need to listen, because it is a very real. We're talking about something very real, a real problem, and we have the ability, still have the ability today, to take responsibility for ourselves and to do something about it. And really clearly, you've just outlined there is only one answer to that, and that is to dump your depreciating, debasing fiat currency for the only money out there, gold and even silver, even though it's not technically a monetary metal.
It is, but it's not valued as such, I would say. And I think that's one of the things that will correct itself. And I'd also add to what you were saying about, protecting oneself. Also got to think about your families.
All right. Look, honestly, I opened up by saying this is manna from heaven. It certainly has been. Thank you so much for parachuting in on this very important day. I think this is one of those milestone days. The beginning of the first quarter, the end of the third quarter has exceeded what the gold's performance, silver's performance has exceeded what everyone who silos their view at the COMEX and the structure around the COMEX, which has now become a price taker, not a maker. And I think then this is a wake-up call, and you've illustrated some numbers here which really open your eyes, because, what an imbalance here. So we have the ability to still act, and not at the end of this year, maybe we won't. So I'm hearing that message very clearly.
Indeed. It's been my pleasure.
All right. Thanks for joining us on this episode of Live from the Vault, brought to you by Kinesis Money. And a huge thanks to Andrew Maguire and our featured guest, Alasdair Macleod, for cutting through all the noise and sharing their invaluable insights that you just won't find anywhere else. So if you like this episode, make sure you subscribe. Make sure you hit that like button, by the way. Turn on notifications so you never miss out on an episode. And don't forget to share this episode with someone who really needs to hear the real story behind the headlines. Now, we're back soon with more hard-hitting truths from inside the precious metal space. And until then, thanks for watching. Bye for now.